brief overview addresses some of the key updates based on guidance issued by Treasury or the SBA and new law passed since the April 1st webinar. These slides and my comments primarily address changes. Please refer to the April 1st webinar for additional information regarding specific loan programs. I'll cover a brief general law update, then address the most popular Paycheck Protection Loans, or PPLs as I originally called them, PPP Loans, or P3 loans as I'll refer to them today. We'll briefly address Economic Injury Disaster Loans, or EIDLs, with a key update for farming operations here. Next, I'll briefly cover the Main Street Lending Program, which I've not addressed previously, but is another potential loan program. Finally, I'll provide a brief update on payroll tax credits and deferral mechanisms available to employers. As a reminder, please consult your advisors regarding your specific situation prior to making decisions based on the general information discussed today. So the newest law that was passed and signed into law on April 24th includes two key updates for industry participants. The P3 loan program has been funded with an additional $310 billion, $60 billion of which is for smaller banks and credit unions. And the goal here is to give a broader group who work with smaller banks and credit unions a better chance at accessing these funds. In the EIDL program, farms with 500 or fewer employees are now eligible to apply. Let's first take a look at the most popular program, the P3 loans, and what's changed. So as a reminder, the P3 loans are available to businesses with not more than 500 employees who pay these employees via W-2 wages or to self-employed individuals. And as I just mentioned, an additional $310 billion of funding is included with the new law after the initial funding was fully used by April 16th. The loan terms, as announced by Treasury on April 2nd of 2020, so just after our April 1st webinar, changed slightly from what we discussed, but it's a 2-year loan at 1% interest. There is a 6-month deferral on the first payment. Interest accrues as of the date the loan is received, but if all of the loan is forgiven, then the interest is also forgiven. There's no prepayment penalty if you decide to repay the unforgiven portion of the loan earlier. And some additional updates, and one of these is late breaking news, based on new guidance issued by the SBA April 24th, racetracks are now eligible for the P3 loans if they otherwise meet the criteria, in other words, 500 employees or less. Racetracks still need to apply the SBA's affiliation rules consistent with other P3 loan applicants. Treasury continues to issue FAQs, the latest of which was issued on April 23rd. Specifically, question number 31 in the April 23rd FAQs provides additional guidance on whether a business with adequate sources of liquidity may sign the certification that due to economic uncertainty, the P3 loan is necessary. There is additional focus and scrutiny on this specific certification due to some large public companies initially receiving these P3 loans. So I recommend industry participants continue to review guidance as issued to determine if the criteria is met when applying for these P3 loans. Some additional updates: partnerships should include both employee payroll costs and self-employment income of partners on the partnership's P3 loan application versus partners separately applying. And the goal here is to streamline the application process and only submit one application versus multiple. For self-employed individuals, the P3 loan is calculated based on the 2019 Schedule C net profit. And Schedule C is specifically mentioned in the FAQs, but I would suspect that the same applies to Schedule F. If net profit is less than 0, then you're not eligible for a P3 loan. The P3 loan forgiveness for self-employed individuals is limited to 8/52 of 2019 net profit. From a what remains the same perspective on these P3 loans, unfortunately, 501c6 entities are still not eligible for these P3 loans, and as I mentioned before, the affiliation rules of the SBA do still apply. So what's unclear from these P3 loans right now? Well, we need additional guidance from Treasury in order to determine the exact forgiveness calculation for businesses. And there are many interpretations given the wording of the CARES Act. Let's move along to Economic Injury Disaster Loans, or EIDLs. As a reminder, a business does not need to have employees to apply for these loans. These loans may be used to pay general accounts payable like training and board. The biggest update here that's beneficial for the industry is that farms with 500 or fewer employees are now eligible to apply for these loans. This would apply primarily to horse breeding operations. Trainers, racing stables, bloodstock agents, sales consignors who meet the small business criteria were already eligible. And the new law provides additional funding for these programs as well. The EIDL Emergency Advance Grants, those that are up to $10,000 per applicant, received additional $10 billion in funding. The general EIDL program received an additional $50 billion to fund this program. Some EIDL program updates. Based on correspondence from the SBA is prioritizing the $10,000 emergency advance grant, which does not have to be repaid, to businesses with 1 to 500 employees and sole proprietors. The SBA is calculating the advance as $1,000 per employee, up to $10,000 in total per applicant. So if I have 2 employees, the SBA will give me $2,000. If I have 15 employees, I will be eligible for $10,000. If I do not have any employees and am not self-employed, the SBA is currently not allocating any of this advance grant to me, even though I am still eligible to participate in the general EIDL program. In addition to the $10,000 advance grant, the SBA will make initial loan disbursements based on 2 months of working capital up to $15,000 per applicant. This is in addition to the $10,000 advance grant that I just mentioned. The $15,000 does have to be repaid, but the first payment back to the SBA is deferred for 1 year. So what remains the same for the EIDL program? Well, SBA is responsible for calculating the amount of loan and the term based on the working capital needs of the business. The affiliation rules still apply, and it's important to refer to the SBA's small business definition for various industry participants, as it may be different than the 500 or less employees required for the P3 loans. I wanted to briefly mention another potential loan program which was included with the CARES Act, called the Main Street Lending Program. No guidance has been issued yet, but this is intended to help those small to mid-sized businesses that did not receive adequate relief from the P3 loans or the EIDL program. And at this time, I'm unsure how many industry participants may benefit from this lending program, but I wanted to at least make you aware of this. So the CARES Act provided $454 billion, which is now up to $600 billion, for loans, loan guarantees, and investments in support of emergency lending by the Federal Reserve. Banks will implement a program as outlined by Treasury in order to make loans to mid-sized businesses. Eligible borrowers are U.S.-based businesses with the majority of operations in the U.S. and employees based in the U.S. So the goal is to support those who keep U.S. jobs, with up to 10,000 employees or up to $2.5 billion in 2019 annual revenues. And these lending programs include one of the following: a Main Street Expanded Loan for loans prior to April 8th, or a Main Street New Loan for loans on or after April 8th. So some of the basics of this program: businesses that have obtained P3 loans may also participate in this loan program. Loans are not forgiven, but prepayments are permitted without penalty. Loan proceeds may not be used to repay other loans or lines of credit, and there's some additional certifications that apply. As far as the loan terms go for this lending program, the interest rate is based on the secured overnight financing rate, which is currently 0.1%, plus anywhere from 2.5% to 4%. It's a 4-year loan term with $1 million loan as the minimum loan amount. Payments on principal and interest are deferred for 1 year, and origination fees apply. Collateral will likely be required. And borrowers must agree to certain compensation, stock repurchase, and dividend restrictions and commit to make reasonable efforts to maintain payroll and retain workers, but specific levels of employment are not required, like the P3 loan. So for new loans, again, there's the new and the expanded. The first of which is the new loan. It's calculated as a lesser of $25 million, or an amount that, when added to the borrower's existing, outstanding, and committed but undrawn debt, does not exceed 4 times the borrower's 2019 EBITDA, which is earnings before interest, taxes, depreciation, and amortization. For expanded loans, they're calculated as the lesser of $150 million, or 30% of the borrower's existing outstanding and committed but undrawn bank debt, or an amount that, when added to the borrower's existing outstanding and committed but undrawn debt, does not exceed 6 times the borrower's 2019 EBITDA. So what remains unclear about these programs? Well, basically everything, with the exception of the general parameters I just mentioned. Treasury has yet to issue any guidance regarding the program, but guidance is anticipated around May 1st, so stay tuned. Let's shift focus a bit, and I'll provide some brief updates regarding payroll tax credits and deferral. So on the deferral of employer Social Security tax, no election is needed in order to defer. The biggest update here is that employers who have received a P3 loan, but whose loan is not yet forgiven, may defer deposit and payment of the employer's share of Social Security taxes beginning on March 27, 2020, until the loan is forgiven. These taxes will continue to be deferred under the normal payment terms for this program, and once the employer's P3 loan is forgiven, this deferral is no longer available. So, for example, if my P3 loan is forgiven on June 30th, I may defer payment of the employer's Social Security taxes between March 27th through June 29th, and those deferred taxes would be due under the normal payment terms, so 50% due by 12/31 of 2021, and the remaining 50% due by 12/31 of 2022. After June 30th, I can no longer defer this tax. The IRS has issued Form 7200, which is used to request an advance payment of the refundable payroll tax credits for the mandatory COVID-19 related leave programs and the employee retention credit. Otherwise, these payroll tax credits are claimed on the quarterly payroll tax returns, and the 2020 second quarter payroll tax forms will be updated to reflect this. This concludes my overview of key updates since our last webinar. Stay tuned as additional guidance is issued and new laws are passed.